We're going to talk a little bit about the new economy, new opportunities for you in jobs and employment, and telescope that into the national economic outlook and the Florida economic outlook. It's important that, I think it's important that you all understand how we got to where we are, where the economy is today, where we're going, and how that relates to what you can do and how you can move forward. Okay, so there we go. Thank you. So the first thing we want to talk about is it really a new economy? Everybody says, well, the world is different now and things have changed. Let me show you this first picture, which really says that, you know, it's not so much a new economy as a cyclical economy. These things go up and down. Recessions are nothing new. Recessions have happened in the past. They're happening right now, and they will continue to happen in the future. Recessions are not a thing of the past, if you will. This happens to be one of the longer and deeper recessions that we've had in the past 60 years. So it frightens people a little bit more, and people think, oh, you know, the sky is falling, it's the end of the world, and it's not really. As you can see from the pictures, in fact, recessions do end, and the lines start to go back up again. And so I think it's important to understand that this is really part of a cyclical economy and not necessarily something new, and that the end of the recession is approximately at hand. Now, in the process of having a recession, we have new opportunities that arise in a recession. Recessions typically cause a structural change in the economy, and it results in what they call creative destruction. So a lot of industries get destroyed, and boy, we destroyed a lot of industries in this current recession. Typically, ones that you may have heard of are the auto industry in particular, and all the automobile parts industries in the United States, which basically went bankrupt. And so the issue is, what really happens in this process of creative destruction, and how can you benefit from that? And I think that the recessions don't necessarily cause these industries to fail exclusively. What happens is these industries are on a very long slide down, and eventually something triggers them to go from positive to negative, and that's when they go bankrupt. And so what happens in a recession is typically the industries which are marginal industries, which are failing industries, which are obsolete industries, those are the things that typically go under in a recession. And the typewriter, I suppose, is one of the better examples of that, as you may know. So now I'd like to play a talk show quiz game with you, a little late night talk show. Name your obsolete industry. Okay, so I've listed a few: the horse-drawn carriage industry, the typewriter industry, perhaps the U.S. Postal Service is obsolete. How about newspapers or Blockbuster Video? Anybody out there name for me a couple of obsolete industries? Circuit Cities, VCRs, or Betamax VCRs, or 8-track tapes. Those aren't necessarily cassette players, not necessarily obsolete industries as obsolete items which may represent a change in the industry. And so some of the things that you're talking about when you talk about cassettes and VCRs, you're really talking about technological changes. Here's another type of game show quiz. Name your relocated industry. Why do industries, if they don't go bankrupt, maybe they go someplace else. Why do they go someplace else? They go someplace else because they want to reduce the costs of labor and capital. So all the steel mills in the 70s moved out to Japan and China. Automobiles today are manufactured in Korea and Mexico. You know, I hear a lot of people that say, I want to buy American, I want to buy a Ford. It's an American car. Yeah, but they're all made in Mexico. You know, it's... If you really want to buy an American car, you might think about a Toyota because they're all made here. Clothing manufacturing went to India and Malaysia and China. Florida oranges have moved to Brazil. We've lost over 100,000 acres in citrus production just in Central Florida in the past 15 or 20 years. So these are all things that start to move and change during recession times. Let's talk a little bit about the national economy. What is a recession? How did we get into a recession, and how do we get out of a recession? I often look at a recession as draining a lake. When we talk about unemployment loss, we drain a lake. We've got a big, or maybe draining a bucket. We've got a big bucket. Somebody punches a hole in the bucket about halfway up, and the water drains out of that hole very rapidly until it reaches the level of the hole, and then it stops. And eventually that's what's going to happen to employment loss in the United States. It's going to drain down until we reach some equilibrium level, and then it's going to stop. And then we're going to have a redefinition of new industries and a redefinition of the labor force, and we'll start to grow a little bit. So let's talk about the U.S. forecast summary. And this is where we get into the nuts and bolts of economics. We do economic forecasting, and I'll try not to make it too boring as we go. But it talks a little bit about the U.S. forecast summary. There is a light at the end of the tunnel in terms of recession. Unfortunately, we are in the tunnel right now, but there's a lot of things that are going on that help us get out of a recession. First is that the President has authorized a $780 billion economic stimulus program. In addition to that, the Congress has authorized the $700 billion Troubled Asset Recovery Program. That's the TARP program. In total, the U.S. government and all of its agencies have committed $11 trillion to stimulate the national economy. So our speaker just before said, you know, we've decided that we're going to stimulate our way out of the recession. It's not so much stimulating our way out of the recession. It's keeping the economy from free-falling into this endless downward spiral vortex. We're just kind of putting a floor on things. But we've made a commitment at the federal level to add as much capital into the economy as possible in order to prevent this endless downward spiral. Basically, when you throw enough gasoline on the fire, you're going to get a very big fire. And so the national economy is going to recover, and it'll recover reasonably strongly over the next few years. The financial markets are stabilizing, and we'll look at some of the indicators, the economic indicators of financial crisis and financial stability among banks and institutions as we get into some of the later slides. But clearly, from our view, the financial markets are stabilizing. The yield curve between long-term and short-term interest rates, which is another measure, is now positively sloped, and that's a good sign for economic recovery. In our view, the contraction has bottomed, and we'll see demand rebounding. When we say demand rebounding, people sort of stopped spending money last December. In the second wave of the financial crisis, the consumer really pulled back in consumer spending, and so we'll see a return to spending. Essentially what happens is people stop spending, and then the things that they have wear out. You know, the cars wear out, the refrigerators wear out, the TVs wear out, and then you have to go replace them. If you don't replace them immediately, you say, well, when things get better, when I get around to it, I'm going to replace that. And eventually, everybody at some point says, okay, now we're going to go out and replace all that stuff. And so that's what drives pent-up demand. When everybody says, okay, all the things that we didn't buy for the past year, we're going to buy now, that's when the economy starts to really rebound significantly. We'll see much higher interest rates coming down the line, and we'll talk about why that happens. And the main risk to our forecast for recovery in 2010 and 2011 is continued financial panic, runaway deficits at the federal level, and the flu pandemic. I have to warn you all, this is how not to get the flu. Want to make sure... want to make sure everybody stays healthy this year. There really is an economic risk to it. Well, let's talk a little bit about some of the economic indicators in the national economy. these are the two big lines. Gross domestic product, that's the indicator of total economic activity in the national economy. That's GDP in the blue line. And inflation in the red line. The Federal Reserve Board targets to keep inflation below 2%. When inflation starts to move above 2%, you'll see the Federal Reserve Board increasing interest rates. Increasing interest rates slows the economy. When interest rates are very, very low, that stimulates the economy. Right now, interest rates are just a smidgen above zero. So in theory, there's a lot of stimulative effect being applied by the Federal Reserve Board to help the national economy recover. You can see in first quarter 2009, GDP, gross domestic product, was almost minus 7%. That's one of the lowest quarterly declines in the past 60 years in gross domestic product. So certainly in your lifetimes, this is the worst recession. In my lifetime, it's the worst recession that we've experienced to date. These are the components of gross domestic product. And so we wanted to, I sort of think of it as a car. And in the old days, it was easy because a car had 8 cylinders. Now they have 3 or 4. But these are the components of gross domestic product. And you can see in each quarter those bars, those components, which include consumption, inventory, the change in investments, net exports, and government spending. All of those bars started to decline. So not only did we have a general recession, but it was a broad-based recession which affected all sectors of the national economy, from consumption to government to exports and international trade. So that's why we had a fairly deep recession. There really were not a lot of segments that stayed positive continually throughout this recession. In terms of jobs, what does that mean? Well, we've lost about 6 to 7 million jobs since nationally since the beginning of the recession. Early in 2008, say the first 6 or 8 months of 2008, we were on track for around 100,000 job losses in the economy per month. When the national economy is humming along, when things are going really well, we grow by about 300 to 350,000 jobs. And that's a sign of a very, very healthy, robust, growing economy. So losing 100,000 jobs, but you can see even in 2006, 2007, we were kind of bouncing along at 150,000 to 200,000 jobs prior to the recession. So the economy really wasn't that robust in 06 and 07. The bubble had already started to deflate in real estate. The only good news with growth like that is that it doesn't cause a lot of wage inflation. There aren't a lot of jobs being formed. There's not a lot of demand for labor, and so wages don't rise all that sharply, and that helps keep inflation down. As we got towards the second wave of the credit crisis in late 2008, we saw job losses on the order of 750,000 jobs per month, 750,000 jobs. So that's what we mean when we talk about creative destruction. It was wholesale job loss. In the couple of weeks where the Congress failed to pass the first stimulus program and the financial markets came to a standstill, we lost almost 1 million jobs a month while they were sitting up in Washington saying, well, we really don't think it's a good idea to pass this stimulus bill. And whole industries were evaporating. So there was a lot of economic damage created in the depth of the recession in late 2008, early 2009. The good news is that you can see, at least through the April numbers and even through the most current numbers in June and July, employment losses have begun to slow. So it's not really a recovery, it's just that things are less bad. I mean, things were very bad and now they're less bad, so everybody views less bad as good. And I agree with them. I think less bad is good. But I think we are on track to slowing job losses, to eventual ending of the rise in unemployment, and a cyclical return to new job formations. In terms of weekly jobless claims, even through June of 2009, you can see finally jobless claims peaked. And that's a a more leading indicator. It's a more current indicator than the employment numbers because it's weekly, and it shows you that there's clearly been a peak, and the peak has clearly started to, and on the downside, jobless claims have started to decline. Again, 350,000 jobless claims is about where we'd say, above that number is about where we'd say we're starting to see a recession. So we've been above 350,000 jobless claims for over a year on a weekly basis. So those are the characteristics which tell you, gee, things really weren't so good for the past year or so. That's the date when the recession ends. November 19th, 2009, 8:30 a.m., when they release the employment numbers, we'll finally see that job growth has begun, job losses have stopped. That's our forecast, and you all can call me up if we don't make the date exactly right, but I think we're very close. I think we're a couple of months away from the end of the recession, and I think that'll make people generally feel better. Florida's a little bit different. Except Florida, yes it is. Florida is a little bit different. New unemployment claims, at least through April of 2009, have not really subsided, have not really declined. Our view is that Florida's economic recovery is going to lag the nation by almost a full year in terms of recovery. The reason is Florida's economy is very growth-based, and we'll talk about this as we go forward, but Florida's economy is very growth-based. And to the extent that the housing market collapsed up north and all the people lost their jobs and people in Michigan aren't able to sell their homes because nobody's got a job to buy that home with and pay for it, it becomes very difficult for people up north to sell their house, move to Florida, and buy one here. So to the extent that this is a growth-oriented state, when growth slows, Florida's economy slows. It's going to take a full year for people to feel more confident that they can get a job and keep a job before the housing markets return in those communities up north that are the feeder communities to Florida. Florida has quite a number of feeder states, and we'll talk more about the Florida economy as we move forward. Other indicators that we were in a deep recession is business sentiment, business confidence. You can see that went negative. I mean, employers just were very, very dismal in their outlook. Consumer confidence was also quite bleak, among the lowest in the past 40 and 50 years for consumer confidence sentiment. And the result was that consumers pulled back. So September through December of last year, 2008, that was the second wave of the credit crisis. If you think back to September of 2007 when the subprime mortgage crisis hit, everybody said, well, I think it's real important that we all understand that the contagion is contained. This is just in subprimes. We don't have to worry about the rest of the credit markets. Boy, were they wrong. They were terribly wrong. That contagion spread throughout all the financial institutions, both in the United States and throughout Europe. And in fact, by 2008, about a year later, the financial markets virtually collapsed. If you remember back at the end of 2008, in the second wave of the credit crisis, when the Congress was dilly-dallying around passing the TARP bill and the $700 billion stimulus program, people were really starting to talk about depression. And what the federal government did and global governments did was they prevented a global depression. Back in January or February of 2009, every major central bank in the developed world simultaneously cut interest rates. That was a global message to all financial institutions and all investors that global governments were acting in concert to prevent a depression. So these are some of the lessons that we learned from the depression of the 1930s, how to handle these kinds of cyclical events. I think they did a really good job. It was uncharted territory. Nobody really understood the depth and the extent of the problem, although they understood it was very big. But simultaneously, on one day, all the governments in Europe, the United States, and China all lowered their interest rates to help prop up financial markets. And it really worked, along with all of the trillions of dollars that have been committed in stimulus programs. But during that time, consumers really pulled back because it was there was a high degree of uncertainty. There was a high degree of uncertainty about presidential elections right at that same time. And so uncertainty, I think probably one of the things that markets hate more than bad times is uncertainty. When you don't know what's going to happen, when you can't predict where we're going to go from here, that's when people become very, very concerned and kind of tighten in all the reins. And so that's what consumers did in late 2008. And by mid-2009, that kind of eased up a little bit. We're not seeing robust growth, but we're not seeing dramatic declines that we saw in retail sales. Existing home sales, you could say people have stopped buying homes and growth completely ended. You know, it didn't go to zero. We've been bouncing along the bottom. We've dropped about 1 million units in terms of existing home sales, but we've been bouncing along the bottom for 6 to 10 months now. There's not a lot of upside on the real estate markets right now, but at least there's a moderate and a steady volume, and that's some stability in the markets. And we've been seeing that for 10 months, so we're confident that the residential markets are reasonably stable. Consumer price index has been very low. In fact, it's been negative. When oil prices went from $140 a barrel down to $37 a barrel at the low, now back to 75. But when they dropped sharply in the early part of the year, that really helped bring the consumer price index, the rate at which products' prices go up, helped bring the consumer price index down into negative territories. We mentioned before that the Federal Reserve Board likes to target consumer price index at about 2% per year, 2% growth per year or below. And so you can see that through most of 2009, these numbers have been well below 2%. That gives the Federal Reserve Board a lot of flexibility in applying stimulative policy to the national economy. So we have a Federal Reserve Board who's inclined right now, given that we've got low inflation, we have a Federal Reserve Board who's inclined to keep interest rates low for quite some time, probably through a good portion of 2010, partly because we have such low inflation. So we talked a little bit before about, the sky really is falling. You know, in December of 2008, it really did feel like the sky was falling. And so all of the economists like myself were called upon to make our forecast of how to reduce uncertainty. What do we do about uncertainty? Truthfully, we had no clue. We just didn't know where it was going. Economic forecasting and astrology became synonymous. You know, we were reading the stars at that point. And so I think it was a very challenging time. Actions to prevent depression. The Federal Reserve Board, we talked about creating stimulus programs for tax rebates, stimulus package for businesses, the troubled asset recovery program, the lower interest rates, flooding the banking system with liquidity. This was the first time, in 2009, was the first time since the 1930s, so the first time in 70, almost 80 years, that the Federal Reserve Board allowed brokerage firms to borrow at the Federal Reserve Bank discount window. And so this was a tool to allow access to liquidity, to allow access to cash in the markets at very, very low rates to help prop up the economy. So those are the kinds of unprecedented steps that we hadn't seen in decades that were taken at all levels of the federal government. So what is the status of the stimulus programs? As we've talked about, the Federal Reserve and the Congress and the President have committed $11 trillion to the federal economy. We've spent about $3.5 trillion already. So we can spend, given what they've already committed, we can spend triple what we've spent on the federal recovery in the economy before we run out of cash. Right now, the Federal Reserve Board is pulling back some of those mortgage purchase programs, pulling back on some of the auto stimulus programs, auto sales programs that we had. We don't necessarily have to spend all $11 trillion. We just have to commit it and say, if we need it, If the economy doesn't do what we think it's going to do, if the economy doesn't start to show a pulse or some signs of life, then we can continue to spend at the federal level to help stabilize the economy. We don't necessarily have to spend it all. Every $1 trillion that we spend means another large level of debt that the federal government has to pay back, and so that's what's coming down the road. Wanted to give you an idea of the magnitude of the financial crisis that we did see. So this is a composite graph of what they call the TED spread, which is the difference in the 3-month London interbank overnight rate. It's the rate that banks charge each other to lend money. So Bank of America says to Citibank, I need some money. Citibank says, here, I'll give it to you at this price. That's the interbank overnight rate. And then there's the 3-month Treasury bill, which you can go out and buy as an investment. And it's a government-backed Treasury bill, so it's very, very secure. It has, in fact, the full faith and credit of the U.S. government. So when Citibank says to Bank of America, I'll lend you money, they say, well, that's a pretty good bet. I'll give you a low interest rate because I think that's a very secure loan. And they peg that. They measure that against the full faith and credit of the United States government. There's probably not a lot of better rates that you can get from the federal government. And so the spread, the difference between those two rates is typically 0.3, 30 basis points, 0.3 of a percent. So back in the late 1980s, we had the S&L crisis. That's not Saturday Night Live. That's savings and loan. Although it could have been a crisis, they weren't that funny then. But this is the savings and loan industry that we're talking about. And you can see that the TED spread spiked to 300 basis points back in 1989. So in 1989, when we had 1,500 savings and loans institutions go bankrupt in the United States alone, we had a deep recession or not a deep recession, but we had a recession that followed a year or so after that. We had the TED spread spiking tenfold what it is on a normal basis. When Orange County, California went bankrupt and defaulted on its bonds, that became very risky for banks that owned a lot of Orange County bonds, and so those banks were under pressure, and so the TED spread, the lending rate between banks spiked versus what the government rate would be. So that was in 1991 or so, Orange County, California. 1997, long-term capital management failed. The TED spread went to 200 basis points. Year 2000, everybody figured in Y2K that airplanes were going to fall out of the sky and the world was going to come to an end at the year 2000. None of that materialized, but it created enough uncertainty that the TED spread, again, rose 5-fold what it normally would be. Shortly after that, 2001, the NASDAQ and the technology bubble burst, and the TED spread again rose to 150. In the subprime mortgage crisis, we rose to about 250 points in 2007. And then finally, at the end of 2008, when the alleged contagion that was contained in 2007 spread globally, and nobody knew how that happened, the markets basically froze up, and the TED spread went to the highest rate we've seen in probably about 50 years, which was 400, and I think it peaked out at 467 was the number. So it's a sign that the financial markets essentially shut down. The Friday before Wachovia Bank failed, they were taken over by the Federal Reserve Board on Sunday. On Monday, they opened as Wells Fargo. The Friday before Wachovia Bank failed, the interbank lending rate between financial institutions and Wachovia was 25%. Those are usurious rates. They were out of business on Friday. They were over. They were done on Friday. Those are the kinds of problems that we saw in financial institutions. So where have we come since then? And this is a picture of what that TED spread looks like now. So again, this is really an illustration of it's a cyclical movement. We have taken many steps to preserve financial institutions, to make easy liquidity, easy cash available to these institutions. And by mid part of this year, April through June of 2009, the TED spread returned back to its historic norm. So it went from 450 points to 45 points down, 90%, and now it's below 40. And so this is what all this really means is that it's a sign that the banks and the financial institutions are relatively solvent, that they're relatively healthy, and that we can move forward in this part of the economic recovery. We're going to see a lot of proposed regulatory reform. The question is, how do we prevent it from happening again? The Federal Reserve will see systematic risk regulator. We'll see regulatory authority over institutions. Basically, a lot of people lent a lot of money to home buyers who could not afford to buy their homes, didn't have proof of income, didn't have employment, didn't have an ability to repay those loans. And they made those loans with no documentation and low documentation, as they called them, low doc, no doc loans. Those were the subprime loans. And that was really fraud that was exercised at all ranges of consumer activity and all ranges of oversight and all ranges of accounting principle and all ranges of quality banking. And so we need to regulate that. We'll see significant additional regulation come on board over the next couple of years. It'll be far-reaching, it's necessary, and it's well-designed. It's also well-deserved. I mean, if you can't behave yourself, you need to have some sort of federal regulation, particularly when it creates global economic catastrophe. So the Obama stimulus package, just a brief overview of that. It's a temporary package. It only goes for about 2 years. There is federal money available for lots of jobs, lots of local government. About 30% goes to business and personal tax cuts. Some goes to health care, infrastructure, and science, and to local governments. Local governments will be one of the last of the sectors of the economy to feel the pinch of this recession because they collect taxes in arrears from property taxes. And so as property values decline, local governments start to lose revenue, but they won't lose more. More of their revenue will be lost in 2010 and 2011 than was lost in 2008, 2009. So local government is going to be one of the hardest hit sectors over the next 2 years, probably not the place you'll be looking for a job. So we've got a couple more slides. I'm going to run through these and get to what I think are some of the more important ones, and then take some question and answer. Going forward, you can see the GDP recovers, inflation stays relatively moderate, the recession is about over, we'll start a recovery, the national economy begins to recover in 2010, a more robust recovery in 2011. Let's talk a little bit about Florida. Florida, we said, is experiencing the worst recession since 1975. Population growth in Florida this year went negative. This is the first time in 40 years population growth in Florida was net negative. We'd seen 300,000 net new growth per year. We've lost 55,000 this year. This is the year-over-year employment change. We talked earlier about the segments of the economy, of the national economy that saw job losses. These are the job losses across industries in Florida, construction, manufacturing, finance, trade, all of those seeing job losses for the first year or so. Those losses have started to moderate, but again, an indication that it's a broad-based recession. Florida has typically been the only state to retire to. Florida has, the land of golf and sunshine. You're probably not at retirement age yet, but there have been a lot of new job growth formations in the service sector and in manufacturing in Florida, in high technology jobs, in medical jobs in Florida. But Florida is really losing some of its competitive edge. because of environmental policies, because of some of the state ad valorem tax policies, because of hurricane insurance problems, because of long-term growth strategy that the state has taken on, and because of competition in other places. North Carolina and Georgia over the past couple of years, in fact, gained more population than Florida did. Florida's domestic population, so people moving to Florida from other states, went negative. Our only source of growth in Florida today is international migration and net natural increase, basically children, babies. And so that tells you sort of the direction of Florida in terms of competition and in terms of what the segments of growth are and population growth are. Florida's population growth probably won't resume until we see return to domestic population growth, until we become more attractive to other states. We've got a lot of information about the housing bubble, about population and employment growth. Just briefly on the Florida housing markets, we built probably 160,000 too many residential units in Florida during the housing bubble. That's about a year and a half worth of residential supply, and we could have wiped that off the market in a year and a half if new construction went to zero, but it didn't go to zero, and so it's going to take us 3 to 4 years to work through the housing bubble. All of our numbers today are showing that the housing markets, the volume of sales has gone up about 100% since January. Prices are stabilized. The excess inventory is coming off the markets, and so housing markets in Florida are stabilizing and stable now. Let me just get to the last couple of slides where we want to talk about what is the new economy and kind of summarize a little bit about where we are. The recessions are normal cyclical events. This one is nearly over. It was a bad one, but it's nearly over. The recovery will be slow. Recovery in Florida will probably lag the national recovery by a full year. So when the national recovery starts to look good in 2010, look to Florida to improve more like 2011. We saw widespread economic destruction. 6 to 7 million jobs were lost nationally. What's the new opportunity for folks coming out of college? What's the new opportunity in post-recessionary era? Structural changes continue to unfold. I think it's really important that you all apply what you know to what are the obsolete industries. We played the late night quiz show game before and talked about what industries are no longer going to be viable 10, 20 years from now. I think you all probably know better than I do what you see is going to be obsolete, how you apply what you know in your daily life to look at industries and job opportunities and say, do I want to go work for a newspaper? Do I want to go work for an auto company? What other industries, when you think about those things, really don't have a valued purpose in the society and are probably going to be obsolete in 10 to 25 years? Position yourself in places other than that. Understand what's going to be obsolete. Trust your instincts when, everybody says, well, everybody's going into housing now. You should go into housing too. Trust your instincts. I guess it was Ronald Reagan who said it, trust and verify. Verify with facts. When you have a notion, when you have an idea of what you think is going to be viable coming in the next 10, 20 years, do a little research on that. Try and figure out and verify if your ideas in fact bear out. That's really important, and that's how to position yourself to take advantage of those opportunities when they come along. Where are the jobs? Not only do you want to position yourself to take advantage of the opportunity, create the opportunity yourself. If you're out there looking for a job, rather than look for a job, say, what is my ideal job? What do I want to create? And go around and create that. Find a company that will say, that'll sit down with you and say, what's your ideal job? And you list 4 or 5 things that you'd want to do, and eventually you'll find a company, you'll find a manager, you'll find a director who says, that's a good idea. It's a really interesting idea. I'm going to find money in my budget for that, and I'm going to make that job for you. you can go out and create those opportunities. That happens in this kind of economy where things are very much up in the air and people are looking for the next opportunity, the next business model to move forward. You know, take those ideas and develop them into a job. And you don't have to have all the right ideas all at once. It may morph into something much quicker than that, but it may also take quite a bit of time before it morphs into the real kind of job that you want. In terms of future trends, we talked about some of those industries that relocated because of labor and capital. They went global. Globalization is a real future trend. To get a job in a globalized industry, you need language skills. You need to understand international trade, how those countries interact with each other, and you need to be able to apply your skills to that industry and to that globalized company. So that's one area of globalization which is very important. Individual empowerment, it's something that I'm clueless about. You know, folks who are in their 50s sit around tables and they say, what really is Twitter? Why do we really want Facebook? What does that stuff mean? You all understand what that means much better than anybody understands how those things have a real importance in international politics, how they have a real importance in shaping public opinion, how they can really help international communication between displaced peoples. Those things is what Twitter and Facebook really do, what they're really for, but there are many other uses that you can think of. And it amounts to individual empowerment. So it's not big media, it's not big government, it's individuals controlling the message, it's individuals controlling the access, and the individuals controlling the contact. And so there's a lot of individual empowerment that's associated with that, and I would urge you to think about how you can continue to create systems, industries, and business which support individual empowerment. Technological efficiency, doing more with less. I mean, the classic example is we don't want a 30 mile per gallon automobile. We want a 100 mile per gallon automobile. We want to do more with less all the time. And so those are the movements towards efficiency and technological efficiency, towards miniaturization, towards eliminating the middleman. All of those things are doing more with less, and those are some big global trends. And finally, healthcare, medicine. Healthcare is a very, very broad industry which covers medicine, treatments, technology, as well as rehabilitation. Quite a number. All of those industries are being affected by all the things immediately above it. They're being affected by globalization, they're being affected by individual empowerment, and by technological efficiency. So that's an industry which has a lot of opportunity. And now I'm happy to take some questions and appreciate all your attention for this long of a time. Thank you.
All right. You mentioned earlier that the Florida orange groves have been moved to Brazil and that we need feeder states to grow as the Florida economy. And what I want to know is, does Florida have an industry on its own that it can stand on its own 2 feet? Like, what can we do to prevent that lag that you talked about, if anything?
Well, actually, Florida's economy is very diverse. It has many industries. I mean, it's well known for beaches and tourism and oranges, but there's, you know, a very, very vibrant medical community, partially anchored by the medical college at UCF. There's a very vibrant aerospace and high technology computer simulation. There's a very vibrant accounting and back office research facilities. And there's a lot of entrepreneurship in Florida. How do you fix the problems in Michigan and Ohio and in the feeder states? Those are things that you really can't control. What you can control is how you position yourself to take advantage of the opportunities when they arrive, to think about where the industries are going, how the world is changing, what things are going to be obsolete, and where are the opportunities, and then position you to be there when that opportunity gets there, or to go out and create the opportunity. Take a risk. You know, if you've got a good idea, take a risk and try and implement the idea. Thanks very much.